Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of cash and cash equivalents, or CCE. As I do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on and look at an example and give you a little more insight. Cash and cash equivalents are the most liquid assets found within the current asset portion of a company's balance sheet. Cash equivalents are assets which are easily convertible into cash, such as money market holdings, short-term government bonds or treasury bills, marketable securities, and commercial paper. Cash equivalents are distinguished from other investments through their short-term existence. They mature within 3 months. Now let's look at an example. Okay, we're looking here at the balance sheet, and of course looking at the assets, and you'll notice below the assets you have current assets, and the first one listed there would be cash or cash equivalents. One other important item to note here, important condition a cash equivalent needs to meet, to satisfy at least, is that the investment should have insignificant risk of change in value. Thus, common stock cannot be considered a cash equivalent. Okay, just so you guys are clear on that, if you're ever wondering. Now, when you're looking at cash and cash equivalent, you want to be able to do a couple different things with it. Number one, know that you can use the number that you're showing here. In this case, $6.5 billion for this particular period of January 30th, 2012. You can compare that to the previous data. You can see that 7.4, roughly 7.4 for the year prior. And you can go back, and it's best to be looking at more than just 3 years, but be looking at 5 or 10, at least 5. Whenever you're looking at that, you're looking for some kind of a pattern, a trend, a change, something of that nature. In this case here, you're looking at 6.5 billion versus 7.4 billion, and not a big difference between these two items here. But if you were to see, for example, this one here all of a sudden jump to say, 15 billion or something like that, you'd want to ask yourself, where did that come from? Because there's only 3 ways that a company can increase cash. A company can increase cash by either turn out and getting a whole bunch of debt, and that would obviously show up as producing a whole bunch of cash in the company's books, but they would also have a debt further down on the balance sheet to justify that change. You would understand that, okay, that's what they did. Or you may see them go out and they may sell some piece of their property or plant, so you may see a decrease in one asset and an increase in another one. That would just be basically changing, moving money from one pocket to the other. So that's important to note. And another way that they could do that would be that the company itself is just making so much money that it's growing over time, and that they're not really using it to grow the operation, or they have been doing that and it's still producing so much cash that it's just building up on them, so to speak. You will notice that whenever that happens, you want to check and see if that's the case, because if you're a long-term investor looking for a quality company, quality companies typically have a great deal of cash. They kick off a great deal of cash. They are very successful. That's what you're looking for as an investor. You want to go out there and find companies that are actually producing large amounts of cash, and they're doing it through their actual business activities, not by going out and getting a whole bunch of debt or selling off their property or their equipment to produce the cash. Okay, that's an important thing to note. Let me clean that up. One more thing you want to take note of whenever you're looking at that cash is if you see a large stockpile of cash or a big increase of cash, and you looked and you don't see the debt as being the cause of it, and the company didn't go out and get a whole bunch of debt to justify it, when they didn't sell off their long-term investments or something of that nature, check your shareholder equity. If that's the only other way to do it, is they would go out there and say, okay, well, we're going to issue a whole bunch of new security to the public, and that would increase their cash as well. So that'd be another thing to watch out for, because that would of course be diluting current shareholders. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.